Have you ever noticed how, after every major financial crisis, the rich seem to get even richer? It feels unfair, doesn't it? While most people are struggling, a new wave of billionaires seems to emerge from the chaos. But what if I told you this isn't just a coincidence? It's a predictable pattern, and understanding it is the key to protecting your own wealth and maybe even growing it. Today, we're going to pull back the curtain and explore the fascinating and often controversial topic: why every market crash creates more billionaires. This isn't about luck. It's about strategy, mindset, and seizing opportunities when everyone else is running for the hills. First, let's get one thing straight. When we say wealth without work, we're not talking about magic money trees. The billionaires who thrive in a downturn aren't just sitting on a beach sipping cocktails, although that might come later. They've done the work beforehand, the work of preparation. Think of it like this. A market crash is like a massive, everything must go sale. Stocks, real estate, entire companies, their prices get slashed. For the average person, this is terrifying. They see their retirement account shrinking and they panic sell, locking in their losses. But the prepared investor sees something else entirely, a once-in-a-decade buying opportunity. The most crucial element here is liquidity, or simply having cash on hand. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." During a boom, when stock prices are soaring and everyone is euphoric, the smart money isn't necessarily piling in more. Instead, they're often trimming their positions, selling off some assets, and building up their cash reserves. They are preparing for the inevitable rain. So, when the crash hits and panic floods the market, they are the ones with the cash to buy up high-quality assets at bargain basement prices. They are buying the same great companies, the same prime real estate, but for 30, 50, or even 70% off. Let's look at the 2008 financial crisis. It was a disaster for millions. People lost their homes, their jobs, their savings, but it was also the moment that created fortunes. Investors who had cash swooped in. They bought shares in solid companies like Apple or Amazon when they were trading for pennies on the dollar compared to their previous highs. They bought up foreclosed properties in desirable neighborhoods for a fraction of their value. Then, as the economy slowly recovered, as it always does, the value of these assets didn't just return to normal. It often soared to new heights. The people who bought at the bottom saw their initial investment multiply many times over. This isn't some secret trick. It's the fundamental principle of buying low and selling high, but executed on a grand scale during a period of maximum fear. Another powerful tool the wealthy use is leverage, but they use it strategically. During a crash, central banks often slash interest rates to stimulate the economy. This means borrowing money becomes incredibly cheap. For someone with a solid financial standing and good credit, this is a golden opportunity. They can borrow money at very low interest rates to buy more assets. So not only are they buying assets at a discount, but they're using cheap money to do it. This amplifies their potential returns. Of course, this is a high-risk strategy, and it's not for everyone. Using leverage improperly is how many people get wiped out. But for sophisticated investors who know what they're doing, it's like pouring gasoline on a fire. Let's also talk about the psychological aspect, because it's huge. Billionaires and successful investors have a different mindset. They've trained themselves to detach emotion from their financial decisions. When the market is in freefall and news headlines are screaming crisis, their heart rate doesn't spike. They don't make rash decisions based on fear. Instead, they stick to their plan. They have a watch list of great companies they've always wanted to own, and they have price points at which they're willing to buy. When the market hits those levels, they don't hesitate. They execute. This emotional discipline is perhaps the most difficult skill to master, but it's what separates the amateurs from the pros. They understand that market cycles are a natural part of the economy. There will be booms, and there will be busts. The crash isn't the end of the world. It's a reset. So, how can you apply these lessons? You might not be a billionaire, and you might not have millions in cash sitting on the sidelines. That's okay. The principles are scalable. First, build an emergency fund. This isn't just for life's little emergencies. It's also your dry powder for when opportunities arise. Having 3 to 6 months of living expenses saved in cash gives you a psychological buffer. You won't be forced to sell your investments at the worst possible time just to pay your bills. Second, invest consistently, regardless of what the market is doing. A strategy like dollar cost averaging, where you invest a fixed amount of money at regular intervals, forces you to buy more shares when prices are low and fewer when they are high. It's a simple, automated way to take advantage of market dips. Third, educate yourself. Instead of panicking during the next downturn, see it as a learning opportunity. Study the companies and assets you believe in. Create a watch list. Understand their true value. That way, when their prices drop, you'll have the confidence to know whether it's a genuine buying opportunity or a failing business. Knowledge is what turns fear into opportunity. Remember, fortunes are not made during the good times. They are secured. They are truly made during the bad times by having the courage, the capital, and the conviction to act when everyone else is paralyzed by fear. The cycle is clear. A boom inflates asset prices, a crash causes a panic-driven fire sale, and prepared investors with cash buy up these quality assets at a deep discount. Then, as the economy recovers, the value of these assets rebounds, catapulting their net worth to new heights. It's a wealth transfer of historic proportions that happens time and time again. It's not about being a genius. It's about being prepared and disciplined. By understanding this process, you can change your own financial future. You can stop being a victim of market crashes and start seeing them as the opportunities they truly are. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more content that helps you navigate the world of finance. What are your thoughts on this? Have you ever taken advantage of a market dip? Let me know in the comments below. I'd love to hear your stories and strategies. Stay smart, stay prepared, and I'll see you in the next video.